Welcome to Requity Insights, a channel dedicated to documenting our journey to 100 world-class communities. Welcome back to Requity Insights. In today's episode, we will be discussing the topic of financing your RV campground, as well as how to determine the size of the deal that you should target. We're going to cover the various aspects of financing available to real estate investors, including seller financing, bank debt, SBA financing, CMBS, life insurance, and debt funds. Let's start with the first question. How do you determine the size of the deal that you should target? The size of the deal that you should target depends on several factors. It includes your financial resources, your investment goals, the current state of the real estate and the debt market that you're entering. Now, typically, larger deals require more money, and that may not be feasible for every investor. So as a general rule, it's advisable to start with smaller deals to learn the operations and overall business of running campgrounds, and then work your way up as you gain more experience and you gain more financial resources to be able to take on bigger deals. Larger deals generally provide the benefit of giving you economies of scale, so you can bring in more revenue, you can support more staff, which in a lot of ways makes operating easier as you go bigger. But again, you have more money at risk. So once you've identified the deal size that you want to target, how do you put together the debt for it, right? Today, we're going to speak exclusively for how you're bringing together the debt for your property. When it comes to the equity for your property, again, this comes from personal capital, this comes from private investors, and we can speak a lot more on how to be able to pull together the equity for a project. But today's show, we want to talk to you about your biggest money partner, usually those that are bringing the majority of the money, which is your lender. As we get into the show, there are a few key concepts that I want to make sure everyone is familiar with, that you want to make sure you're asking yourself as you're evaluating the different loan options that are available. Few key concepts that are important before we dive into the 6 different types of loans. Fixed versus floating rate. That means, is your interest rate fixed throughout the entire lifetime of the deal, or is it floating as your interest rate index goes up and down? Then you have to be familiar with your interest rate index. Your interest rate index is generally the number that the banks are benchmarking your interest rate upon. So usually these index include the treasury rate, the 5 or the 10-year treasury. You have the overnight federal funds rate, otherwise known as the SOFR rate, and you have the prime rate. These are the most common 3 indexes that we see lenders benchmark off of, and usually there is a spread. Your interest rate is just equal to a spread above each of those index. You also have your interest-only period. Interest-only period can vary, and we'll get into that. But that's the period of time that you're not having a principal payment due along with your interest payment each year, which lowers the amount of money out of pocket you have to put towards your loan. Then you have your amortization schedule, which is at the point in which you do have a principal payment due alongside your interest payment. How much that principal payment is equal to is based on the amortization schedule. You have your loan term. The loan term is simply the life of the loan. So a lot of times, though you might have a longer amortization schedule, a 30-year loan, you may have a loan term of only 5 to 10 years, which means that you will be paying it down on a 30-year schedule, but you will have a balloon payment due at the end of 5 or 10 years at the point in which it's time to refinance or look at exiting the property. Minimum loan amount varies by the type of lender you have, but this is the loan amount that they need to see as a minimum before they'll consider giving you a loan. You have your maximum LTV or LTC, so that's loan to value or loan to cost. Generally, every lender or every bank option has some kind of a maximum that they'll set either based on the value of the property, or otherwise known as the purchase price of the property, or the cost, the total cost of the property, which can be either your purchase price or your appraised value, in addition to the improvements that you plan on putting into the property or your CapEx budget. You have your DCR, your debt coverage ratio. Debt coverage ratio is a ratio that's determined by your NOI divided by your debt service. So generally, most banks have a minimum amount of overage above your debt service that they need to see to give the loan enough breathing room to make sure that you can comfortably service the loan ongoing. You have debt yield. We won't spend as much time on this, but this is another thing that lenders look at, which is effectively what is their return on that loan if they were to purchase the asset for the amount of the loan. Then you have non-recourse versus recourse. So there are a lot of different types of non-recourse and different carve-outs and different aspects of this, but big picture, what this means is that when you have a non-recourse loan, your personal assets are not on the line or at risk, where simply the bank will just take the keys and take over the asset itself. Therefore, it's only your initial equity at risk with a non-recourse loan. Whereas when you have a recourse loan, that means that not only is the bank collateralizing the property itself, but you're also signing a personal guarantee and putting your personal assets at risk, signing a recourse loan. So those are some key terms to become familiar with, and you're going to hear me reference those as we dive into the 6 different types of debt. So let's jump in. Number 1, and probably the favorite to a lot of real estate investors, is seller financing. So seller financing is also known as owner financing, and it can be an attractive option for investors that are looking to acquire campgrounds or other types of real estate when you don't have either the capital to purchase the entire property outright, when you can't find a competitive loan option, or you simply want to negotiate just better financing terms than what's available on the market. The seller financing is an option that, say you have a seller that is really fixated on their price. They want the best price ever, and you realize that you just can't make sense of that price. Seller financing is one of those levers you can pull to be able to negotiate a deal by saying, well, I can pay you that price if you're willing to hold a note that is at a lower interest rate than what the market can provide right now, right? One word of caution I always want to bring up is that when you're looking at a seller finance deal, you want to ensure that you don't you don't start the conversation with the broker or a seller saying, hey, I don't have any money, can you finance the whole deal for me? Because that is not going to happen, and that is generally not the way seller financing is used. It's usually used as a reasonable financing option that is there to simply just replace the bank's loan. And you have to look at the position the seller is in, because the seller needs to make sure that they don't have a mortgage that they need to pay off that's too big to do seller financing, and that they're comfortable holding the note. But in a lot of cases for the seller, they're interested for tax reasons, for cash flow reasons, and other things along those lines. So the big benefits to you of seller financing for buyers, they include that the lower closing costs, you have a much faster closing process, and a lot better flexibility in the loan terms. So for example, we have the ability to negotiate the interest rate, the repayment schedule, and other loan terms directly, which can result in a lot more favorable terms for the buyer than what you might be able to find in the traditional lending market. This can also be an advantage for buyers who may not have a strong, credit score or history as a buyer. The seller might be more willing to work with that buyer than a traditional lender would be. Seller financing can also benefit the sellers by allowing them to sell their property more quickly and potentially for a higher price. This is because, as we mentioned, the seller is essentially becoming more of a lender and therefore is able to earn interest on the loan, and that kind of gives them some alternative cash flow now that they're selling their asset. A lot of the times when you see seller financing, it's because the seller is having trouble selling the deal. So when a broker will present seller financing, usually you want to proceed with caution, because that might mean that either normal banks might not be able to get behind the deal, or it may be just a deal that is less attractive, so they're offering that as a way to incentivize investors. So you always want to start with the why and figure out, why are they willing to seller finance the deal? Especially if it's something that they're leading with in advertising, because there might be a reason behind it, and hopefully it's a good reason, just as maybe they have tax benefits to holding the note, or they want that consistent cash flow that comes along the way. But overall, seller financing can be a really attractive option, both for buyers and for sellers in the right situations, and it allows for greater flexibility and potentially for more attractive financing than traditional lending options. Number 2 is bank debt. So there's 2 different types of banks that we'll talk about. You have national banks and regional banks. So bank debt is a common form of financing, probably the most common, used to acquire RV campgrounds, with lenders that are typically offering various size loans based on their underwriting guidelines. The terms of the bank debt can vary depending on factors such as borrower's creditworthiness, track record, the property's location, the condition, and the loan amount required. Typically, the bank debt is used to acquire RV campgrounds that it may come from in the form of a commercial mortgage loan, with a fixed or variable interest rate, and the repayment terms ranging from somewhere usually between 5 and 10 years. So lenders also require down payment, typically between 25 to 40% of the purchase price, and sometimes they'll also finance some of the improvements of the property. So banks nearly always require personal guarantees from borrowers, and much of their loans are generally recourse or at least partial recourse. They also generally want to see a walk-in 125 to 135 debt coverage ratio, meaning the property is showing healthy ability to be able to cover the ongoing loan payments. So banks tend to provide less interest only. Often they'll provide maybe 1 or 2 years of interest only, depending on how much value add strategy is entailed. The amortization schedules can really vary, especially for campgrounds, we've seen between 20 up to 30 years. And prepayments are generally pretty flexible. A lot of banks will offer what we call like a 3-2-1 prepayment, meaning it's 3% of the loan balance year 1, 2% year 2, 1% year 3, which is what we'd consider to be a fairly light prepayment, giving the borrower some flexibility. And you usually see that when you have a recourse loan, you have a little bit more flexibility on your prepayment options, because most people that offer any kind of recourse product realize that you may not want to be tied to that forever. So it's generally tied with having a little bit more flexible prepay. And now to talk on regional banks versus national banks. When you have regional banks, these are usually banks that are more generalists, that will specialize more in investing in this region than they will investing in this product type. So regional banks are usually good lenders when it comes to campgrounds if they know the campground well, they know the history of it, maybe they know the current ownership group, maybe they've held the note on it for a long time. But regional banks can be really difficult when they don't have experience with the product type. So that's just one thing you will run into. Whereas national banks, there are banks that are more specialists when it comes to the product type. So they understand campgrounds, they know what they're looking for, they have a process to underwrite. So we've often found a little bit of an easier time in this niche asset class, working with national banks that understand the asset class a little bit better. But there are definitely pros and cons to both, and I would encourage you to explore both options. Financing type number 3 is SBA financing. So the Small Business Administration offers the SBA 504 financing, which is a government-backed loan program designed to help small business owners access financing. Now, the beauty of this is in traditional real estate, if you're buying multifamily property or industrial or office space, you're generally not able to receive SBA financing. SBA is eligible for a lot of campgrounds, especially for those that are majority transient sites, because these campgrounds qualify as more of a small business than they do as just a traditional real estate product type. So knowing that, this can be an attractive option for investors looking to acquire RV campgrounds, as SBA loans can offer a number of benefits. One of the key benefits to SBA financing is that the loans are backed by the federal government, which means that the lenders are able to offer more attractive terms than borrowers and they might be able to get with traditional financing options in the private market. The most attractive thing about SBAs is that they'll finance up to 90% of the purchase price and the improvements of the property, which gives borrowers a way to buy an asset without very much money out of pocket. SBA loans can go up to $5 million in total loan value, and they require that the borrower has a net worth of less than $15 million, as these are intended to promote small business owners throughout the country. So for example, SBA loans may have lower down payment requirements, longer repayment terms, and more flexible underwriting criteria, which can make it easier for investors to qualify for financing. Prepayment penalties typically are around 5% for year 1, 3% for year 2, 1% for year 3. These are fully amortizing loans. Generally for campgrounds, they'd be 20-year fully amortizing loans because of the real estate component, and they often have either a fixed or floating rate that is tied to prime. These are full recourse loans. They will actually require personal collateral when it comes to the loan types and ensure that they really are going to have probably the highest level of recourse out of any loan type available. Another thing to be aware of when it comes to the SBA loans is they have a very, very extensive due diligence process. I would say more so than traditional banks do, which I think as a new borrower or a small business owner can be valuable to you because it's going to hold you to a high standard. But just know it is a very in the weeds due diligence process as they vet you as a borrower and as they're vetting the asset and your improvement plans. They do have fixed and floating loan options available, which is nice so that you as a borrower may have some element of being able to choose whether you want to hedge against the interest rate risk, depending on where the market is and where rates are at the time. And the interest rate index is generally based on either prime or the treasury. Financing type number 4 is CMBS. So CMBS, or commercial mortgage-backed securities, are the type of financing that are typically used for large commercial real estate deals. One of the key benefits is that it can provide you with a lot of access to capital. So these loans can get very, very large, and we see them used for either acquiring or refinancing real estate properties. Another big benefit of CMBS is that this is a non-recourse option. So as you start to get to larger deal sizes, generally a lot of borrowers feel more comfortable having non-recourse options available to them. So generally, as you go to larger deal sizes, you usually hit a certain threshold where banks may stop looking at deals. It depends on the bank. National banks may be able to lend 50 million, maybe up to 100 million per borrower, but there usually is a certain threshold where there's a limit to how much they can lend on either a per borrower basis or on an individual deal basis. And obviously the SBA is an option that makes sense for early people that are starting off, but it only has up to a $5 million loan balance. So CMBS is one of the product types that, especially in the RV campground, one of the few sort of non-recourse product types that allows you to really scale over time. And I think that's one of the aspects to this that makes the most sense. And it is a non-recourse option, which means that you start to reduce your personal risk as you are growing and scaling in your business. Now, CMBS loans will offer, usually it's a fixed interest rate, and it can be a longer repayment than a lot of the traditional financing options, which can provide you with a lot of greater sort of predictability and stability from your financing. It also makes it a little bit easier to manage your cash flow when you have fixed interest rate financing. Now, CMBS does not come without its downsides. Generally, CMBS loans requires the borrower to have a defeasance payment, which means that the borrower is responsible for the interest throughout the entire lifetime of the loan, which can lead to extremely costly prepayment penalties. So if you think about that, you have 10-year long loan, we'll say, right? And you have interest rates are 6.5%. That means that if you were to sell in year 3 of the property, and sometimes they even have lockout properties restricting you from selling, but if you were to sell in year 3 of holding the loan, you'd owe that 6.5% rate for the entire lifetime of the loan, which ends up being a pretty meaningful amount. That could be 40% of the loan value as a prepayment penalty, rather than, we talked about banks before being 3% of the loan value, 2% of the loan value, and 1% of the loan value. So it could be literally 10 times as much of a prepayment penalty, which means that when you get into a CMBS loan, you better get in and be ready to stay in throughout that lifetime of the loan, because that prepayment penalty in those early years can be very costly. This is why we usually deem CMBS to be a better option for what we call a takeout option or a refinance option than it is to be simply a going in loan to purchase the value-add properties. CMBS is also, it's just a little bit less relationship driven. And anecdotally, we've heard that they can be less forgiving when it comes time for borrowers running into tough times than maybe a bank that they have a long-term relationship with. So overall, CMBS financing can be a great option for investors that are looking to acquire or definitely refinance large commercial properties such as campgrounds. It can provide access to a large amount of capital in a non-recourse structure with fixed interest rate, lots of interest only, which can help reduce your risk and provide stability for the long term. So generally, CMBS is very friendly towards interest only. We've even heard of full-term interest only CMBS. When it comes to amortization periods, they're usually somewhere around 25 to 30 years, depending on the loan. When it comes to the loan term, they can be anywhere between 5, 7, and 10-year loans. And usually these start at a minimum loan size of around $2 million. I've heard of them going lower, but the fees are really heavy up front. So on small loans, it really starts to stack up. When it comes to your maximum loan to value, it's usually around 75% of the initial purchase price. But more often than not, it's DCR constrained and DCR based. So they're going to fund up to where you have either a 1.2 or 1.25 debt coverage ratio based on your historical financials. And that pretty much sums up what there is to know at a high level about CMBS financing. All right, financing option number 5 is life insurance companies. So life insurance companies offer loans to real estate investors that can be an attractive option for financing for those that are looking to purchase generally large income producing properties. Usually this is a great alternative to CMBS product. One of the key benefits to a life insurance company is that they offer fairly long repayment terms, usually longer than traditional banks. They offer more non-recourse. They provide investors with greater flexibility in managing their cash flow and can make it easier for the people to finance with long-term income streams such as RV campgrounds. So one of the big things to know about life insurance companies is that oftentimes they are targeting higher quality assets in good locations. Though, again, every life insurance company, there's so many out there, they're all going to have a little bit different criteria. Minimum loan amount for life insurance companies can generally be starting at $1 million, but usually I see it be on the higher side, above $1 million. Interest rate index for life insurance companies, generally these are fixed rate, and every life insurance company is going to define what that rate is based on different indexes. Loan terms, these can usually be anywhere between 5 to, we've seen them as long as 30-year long terms, with an amortization also up to 30 years. Generally, LTV can be around 70%. Life insurance companies are, remember, these are insurance funds, so they're usually going to be pretty conservative, and they're not going to want to be super high leverage on your deals. And they usually are looking for a debt coverage ratio of somewhere between 1.25 to 1.35 going in. Life insurance companies are usually non-recourse, so that is one of the big advantages, is that this is kind of an alternative to your CMBS as a large non-recourse option. And then when it comes to your prepayment penalties, these can be either yield maintenance, or you do see also a step-down prepayment penalty be available as well. And lastly, number 6, debt funds. So a debt fund is usually a private fund that is created with the intention of being able to back real estate operators on various strategies. And this is one thing we've started to see more of within the RV campground space for both development, but mainly for acquisition loans. And this is effectively someone that sees an opportunity to say, hey, people are either struggling to get debt here, or there's an opportunity to get a nice return on our money by being able to lend sponsors, various operators, debt. That's what a debt fund is, but usually these are closed-ended funds where they raise a bunch of equity to then go and they raise a bunch of capital to go invest into debt products, usually on maybe like a 10-year timeline. So you got to think this is a fund that has sort of a fixed timeline in mind. And that takes me to the length of the loan, which varies, but knowing that these are usually closed-ended funds, they are often 5, maybe 10 years, but you even see some of these loans be on 3-year terms with extension periods that require extension fees after the fact. The amortization schedule can really vary. Some of them are pure interest only, or at least several years of interest only on the front end. And then if there is an amortization schedule, we've seen it be anywhere between 25 to 30 years after the fact. So prepayment penalties also vary. Every fund is going to be a little bit different, but we generally do see that these are offering some kind of a step-down option for prepayments, but you could also see them as yield maintenance as well. In terms of leverage, I think this is one of the probably areas that debt funds are more competitive in, is maybe speed once they're familiar with the borrower, and leverage. So they can offer a higher amount of leverage than traditional lenders, especially that's what we've seen in the RV product type. We have seen some that go up to 80% loan to value, which is not common to see with the other types of financing that we've touched on thus far. Rates can be based on different interest rates indexes. It's really whatever the fund deems to be their index of choice that they're going to be targeting, and they can usually charge, I think this is kind of the trade-off with debt funds, is usually they're going to give you a little bit more leverage, but they're going to charge a higher rate in return for that additional leverage. So that's just something to be aware of. And there also could always be some different fees associated with debt funds, maybe less clean than the other lending options that we mentioned, where usually it's just an origination fee. So definitely make sure you're reading through the fine print and seeing any of the fees that might be involved or charged to the borrower. All right, great. Well, those are the 6 types of financing, and now we're gonna get into a couple other bonus topics that we wanted to hit on. So in addition to selecting the right financing option, it's important to know, how do you finance improvement costs? So we initially touched on LTV versus LTC. There are several different options for financing your improvement costs. Generally, you're either taking out a construction loan or using a cash out refinance. So one of the best tips that I can offer is when you are going into a loan, when you're going in and you have a heavy construction budget on either an acquisition or refinance, is get not only an appraisal for the as-is, because by default, the lenders are going to order an appraisal which is as-is, but if you work with the lender, you should also encourage them to order an as-improved appraisal, which will tell you what the value is now, but it will also give you a value for once you've improved the property and put more money back into the property, this is what the updated valuation would be. And for lenders that will loan on loan to cost, they will sometimes give you a line of credit or the ability to draw down additional loan proceeds once you've put in the improvement money to the property. And that's generally how you're gonna be able to, that's probably the number one way to be able to finance your improvement costs. How much debt should you use? The amount of debt an investor should use really depends on their individual financial situation and investment goals. Generally, it's advisable to use a conservative amount of debt that allows for a comfortable cash flow and ensures the ability to make timely mortgage payments. One thing we did not touch on is if you go into a loan, the lenders, most banks are going to require that your net worth is equal to your loan balance. So if you're going to get a $10 million loan, they usually want to see that either you or you and your partners have a net worth of $10 million to be qualified for the loan. In addition to that, they also want to see liquidity amounts usually equal to 10% or so of the loan balance. So if it's a loan balance, again, of $10 million, that means that you and your partner's combined net worth should equal $10 million or more, and liquidity should equal $1 million or more for most types of loans. So again, that could be another advantage of seller financing, is it's not always as strict, and there's some of the banking relationships may not have as strict of guidelines, but broadly speaking, that's usually what people want to see when it comes to what we call the balance sheet strength of the borrower. Additionally, investors should consider the type of debt they use, such as fixed or floating rate, explained earlier, and then choose the option that is going to best align with their investment goals and financial strategy. We generally almost always opt for fixed rate because we want to minimize the interest rate risk that comes along with our investments. So for investors that have a long-term investment horizon, you may prefer the fixed rate debt to lock in that predictable interest rate and avoid the risks associated with floating rate debt. Whereas if you're really in it more for a short-term investment horizon, you may just opt in for the floating rate option because it might have a lower prepayment penalty, so you're not really as concerned with the interest rate risk. In conclusion, I'd really like to stress that choosing the right financing option is crucial for real estate investors, as it can significantly impact your ability to generate your returns and achieve your investment goals, right? It has a lot to do with your underlying levels of risk in your investment. So investors should really do their due diligence and work with an experienced professional to ensure that you're making informed decisions about financing your real estate investments. If you're looking to finance a campground and you're early to the space, I would recommend finding a good loan broker that can introduce you to several different product types so that you have options to be able to choose from. So that's all for today's episode. We hope that you found this information helpful. If you have any questions, comments, feel free to reach out, and be sure to like and subscribe to our YouTube channel, as well as follow us on all the major podcast platforms. Thank you for watching, and as always, don't forget to share. So we'll see you next time. Thanks for tuning in to another episode of Requity Insights, hosted by our team at the Requity Group. You can find recordings of all shows along with our opt-in form to set up a call and view future investment offerings on our company website, therequitygroup.com, also listed in the show notes.